For the first time, Wall Street's presence vanished from major Canadian dollar bond deals. Not a single American banking logo appeared in Ontario's $2 billion bond issue or Alberta's $4 billion mega deal. The port cranes may still be operating, but, alarms are ringing across Bay Street. A financial alignment that stood for over 50 years between the United States and Canada is showing visible cracks. In their place, London and Frankfurt, quietly stepping in to fill the vacuum as Canada's government encourages industries to pivot to Asia. These tariffs with Washington have begun dividing more than just goods and services. They're splitting capital flows. And the bigger question is looming: can North America's supply and finance systems withstand this shock? Or has the dollar-dominated system suffered a critical hit? Don't miss what's next. Subscribe and hit the notification bell. This one's going to rattle both your portfolio and the markets. When Ontario launched its $2 billion 10-year US dollar bond in early June, everything seemed normal on the surface. The bonds sold out fast. Pricing barely made the headlines. But something was different. No U.S. banks were at the table. Their spots were taken by Barclays, RBC, CIBC, and Scotiabank. There wasn't any popping champagne, just quiet handshakes, uneasy glances, and the acceptance of a new truth. The tariff standoff with the U.S. had now reached the financial sector. Dismissed by some as political theater, the move sent shockwaves through Bay Street, precisely because these bonds were still denominated in U.S. dollars, using America's liquidity. But Canada had stopped waiting on the sidelines. It was beginning to build its own channel. By mid-March, Alberta made a bolder move, excluding Bank of America from a €4 billion issuance. Inside Calgary's high-rise towers, risk teams watched the sun hit the snowy peaks outside while betting that Europe would help absorb the fallout. This pivot to Europe triggered changes at every level. Banks updated risk models, asset managers increased euro exposure, and swap desks started hedging more aggressively across the euro to US dollar spread. The transformation reached everyday professionals. Elaine, a pension fund manager in Edmonton, canceled her quarterly trip to Washington. Instead, she met regulators in Frankfurt over lunch. In London, a broker casually handled a Toronto-to-pound swap like it was routine. The financial mood had shifted. Not panic, just a sense of stagnation and rebalancing. Beneath the calm, tremors were building in lower-tier credit markets. In the background, Canada moved to remap its export links. At Export Development Canada, outdated Southeast Asia market maps were updated. Storage plots near Brazil's Port of Santos were flagged as strategic. At Montreal's Logistics Expo, a surprising number of Vietnamese brokers attended, all focused on how to optimize Canadian freight, without relying on U.S. bank guarantees. Meanwhile, unease was growing in Washington. Canadian bond mandates, long a stable, quiet source of Wall Street profit, had been severed. These deals don't grab headlines, but when commission lines vanish, they sting by year-end. At J.P. Morgan, senior managers found themselves unable to include Canadian lines in their latest tenders. In response, a quiet question began to echo in finance halls. If you pull out a single stone, does the wall begin to shift? Ontario's bond desk wasn't the only place where policy changed. In April, the province quietly inserted a rule into its public procurement system. No U.S. suppliers could win contracts unless no Canadian or allied suppliers were available. This meant every tender, from steel rivets to IT systems, had to be sourced in Canada first, then from partner nations, and only finally from the U.S. At a provincial hospital, a procurement officer hesitated when a bid arrived from Stockholm, not Seattle. But when exchange rates were considered, the Scandinavian proposal came out ahead. In the FX markets, the real shakeup was at the lower levels. When the tariff fight began, the Canadian dollar weakened, then stabilized alongside a rise in Brent crude prices. But for smaller firms, the uncertainty meant tighter capital, fewer options, and more risk. From pension managers to procurement teams, from swap desks to farm exporters, a new era was unfolding, less tied to Wall Street, more anchored to Europe and Asia. As Ontario and Alberta gradually stepped back from U.S. syndication, Something subtle but meaningful has happened. A technical fracture has appeared in the USD-CAD financial infrastructure. Some Canadian banks began widening liquidity buffers in their evening models. One commodity firm in Vancouver shared that finding US dollars after 6 p.m. has become harder, something not seen since the 1998 Asian financial crisis. This repricing of balance sheet risk opened small windows for domestic players. A mid-sized solar panel manufacturer in Thunder Bay doubled its market share thanks to tariffs on Chinese solar imports. But the victory was fragile. When a shipment of copper coils from Shanghai was delayed by 3 weeks, production lines shut down and costs soared, reminding everyone that even local gains remain chained to global supply lines. In Alberta, a different kind of momentum was growing. The province pushed for new oil loading ports on the Gulf Coast and laid plans for tanker routes to Asia via the Pacific. This initiative aimed not just at expanding exports, but at partially financing Canada's dollar needs independently, outside of the U.S. financial system. European insurers were looped in. Brent crude pricing provided a natural hedge for the Canadian dollar. But when pipeline protests escalated, risk premiums climbed and, well, green finance mandates made European Union investors more cautious. In this complex dance of global capital, the United States still holds significant power, the trump card, as it were. Though the White House now gestures toward policy normalization, the legacy of tariffs still looms over every transaction. Even if tomorrow's headlines announce a tariff rollback, Canadian risk managers aren't reverting. Diversification is now baked into strategy memos. Swap desks are aligning their models with the European Central Bank, not the Federal Reserve. When London custodians started opening sub-accounts for Canadian institutions, the message was clear. This shift isn't temporary, it's intentional. Of course, U.S.-Canada capital flows remain massive. By the close of 2023, U.S. firms will have nearly $500 billion invested in Canada, while Canadian portfolios in U.S. markets edge closer to $1 trillion. But markets move slowly, political noise moves fast, and in between lies the tension. The financial base, the mountain of capital, is still solid. But the snowpack at the top, warmed by tariffs and nationalist procurement policies, carries avalanche potential. Even a modest rise in risk premiums can shorten bond maturities, raise guarantee costs, and trigger real-world consequences. In Montreal, a small insulation materials company is now considering moving its new factory from Ohio to Saskatchewan. Why? Not tariffs. Financing uncertainty. On the same day, a Boston asset manager didn't sell their Canadian bond holdings, but quietly hedged for a 5-year trade war. As Bay Street greeted another gray morning, the seasonal slush had frozen over. Beneath the lamps, ice solidified into new contours, signaling a shift. Banks in London, brokers in Frankfurt, swap desks in Singapore, and institutions in Tokyo are now leaving permanent marks on Canada's financial ecosystem. Whether you call it symbolic separation or strategic autonomy, a line has been drawn. Canada and the United States will still dance together. But the tempo has changed, and now it's louder, more complex. And as analysts scan the Bay Street skyline, one core worry emerged again. If this financial polyphony fails to harmonize, will Canada adapt beneath the ice, or will everyone in the pool gasp together, cut off from oxygen? Time will tell. As new capital arteries reach from the Singapore dollar to the British pound, from oil to rare earths, any sign of a clog or freeze will be closely watched, in Toronto's glass towers and Calgary's oil terminals alike. Because finance, like water, finds a way, as long as there's a crack to flow through, without being sealed by ice or ruptured by pressure. What do you think? Share your thoughts in the comments below. And to stay updated on global financial shifts, don't forget to subscribe and enable notifications. Thanks for watching.